Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 14th of May. I'm Daniel Lam, your host for the podcast. The recent moves in the US and Hong Kong China equities have been grabbing investors' attention. But Japanese equities also have done very well consistently this year, and the topics has continued to post strong gains in the high teens in yen terms year to date. But with the yen seeing a sizable depreciation, returns in US dollar terms have been relatively modest at around the mid-single digits. Now, as we said before, Japanese policymakers like to err on the side of caution. They want to make sure that the wages and price growth cycles do really get sustained. In the meantime, the increasingly hawkish tone from the Fed over the past few months led to position build-up in the long dollar and short yen carry trade. Now, there has been currency intervention from the BOJ, so for the data released as of the end of April, it shows that the BOJ drained 48 billion US dollar in liquidity from the financial system, and that's well above money market estimates. But then intervention is not for free, because it means drawing down US dollar reserves for every time they intervene. And for the hedge funds, they are looking at the currency strength and weaknesses. They see that the RMB has been relatively weak, and valuation is cheap for Hong Kong China equities. So there have been reports of macro hedge funds selling Japanese stocks to cover short positions on the Hong Kong China markets, while some active managers have started to build long positions in Chinese equities. But in the podcast yesterday, we reiterated our stance that while short-term opportunities do exist in Hong Kong China equities, there are structural issues to overcome there in order to see more sustained growth. So, for a 6 to 12 month horizon, we continue to be overweight Japanese equities. Earnings remain healthy with 2024 and 2025 estimates at 8 to 10% roughly in US dollar terms. Tourism numbers continue to climb, with expectations of roughly 32 million tourists visiting the nation in 2024, breaking its 2019 high. Japan corporates are unlocking shareholder value via record-level buybacks and dividends. Now, foreign investors' flow have remained strong into Japan, roughly around 2 trillion yen year-to-date this year. More importantly, the recent National Insurance Savings Account, i.e. NISA, reforms is expected to be an additional catalyst with regards to domestic ownership. And there has been over 1.7 million new NISA accounts opened by the end of March this year, a tripling of total traded value and pickup in Japan equity NISA approved funds. Lastly, over 95% of equity exposure within the growth quota NISA, which accounts for 60% of the total NISA value, they have been towards domestic Japanese stocks. So that indicates greater interest from domestic retail investors in Japan. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.